FunSupermart.com.
What is your outlook on Asian debt for 2012?
Okay, the Asian credit market or the Asian bond market, the US dollar bond market has delivered very consistent and decent return over the last 10 to 11 years. Over the last 10 years, has delivered about 8.6% annualized return. And over the last 1 year in 2011, it actually delivered 4.1% return in US dollar terms, even as equity market went down by double-digit returns. For 2012, we remain constructive on Asian US dollar bond market. We think that this bond market should be able to deliver at least 5 to 7% total return to investors for this year. As it stands for the first 3 months of 2012, the Asia US dollar bond market has already delivered 4.0% return in US dollar terms, and hence we think that this particular market should be able to deliver 5 to 7% return for the whole of 2012.
What are some of the key drivers for Asian debt?
I think one of the key drivers for Asian debt performance would be the fact that for Asian US dollar bonds, most of the bonds bond yield continues to be a lot higher than similarly rated US companies and global companies. So for example, a BBB rated Asia bond currently yields about 4.5 to 5% yield. This is roughly about 100 to 200 basis points higher in yield versus similarly rated US companies and global companies as well. And hence we think that this 100 to 200 basis points of yield premium is likely to narrow in the course of this year, and this will be a key factor that will deliver upside performance for Asian bonds. Other than this credit spread tightening, I do also see that some of the Chinese single B and double B rated companies, these companies sold off massively last year. Even with the recent rally that we saw in the first 3 months of this year, right, the yields for these Chinese companies continues to be very, very high at between 10 to 50%. So we do see possibility that the yields for these companies could actually continue to fall, and hence pushing up the prices of the bonds for the single and double B Chinese companies. And this will also deliver performance for the Asian bonds. Another possible driver of Asian bonds performance will also be the fact that other than Indonesia being upgraded to investment grade status by the rating agencies, I do see the possibility that Philippines could also be upgraded to investment grade status by one of the rating agencies either by end of this year or at the latest by the first quarter of next year. And this will of course deliver another upside performance for the Asian bonds.
What about the downside risk?
Well, when you buy fixed income products or bonds, right, there are essentially 3 kinds of risks. The first risk will be the interest rate risk. The second risk will be the FX risk. And the third and final risk will be the credit risk. Let me talk about the interest rate risk first. So interest rate risk is the risk that the bonds may drop in price or in value when the US interest rate begin to rise. Now, this risk can actually be easily hedged away by selling US Treasury futures at a reasonable cost of about 0.2 percentage points on an annual basis. Or if you want to minimize your duration risk, you can actually buy shorter dated bonds, like 2 to 3 year maturity bonds, to avoid the interest rate risk. So this risk is actually quite manageable. Now, the second risk is the FX risk. So if you're Malaysian-based investors and you buy an Asia bond that's denominated in US dollar, so if ringgit strengthens against the US dollar, then you may actually lose some of the value of the bonds, given that you have to convert these bonds into ringgit. So again, this risk you can easily be hedged away. So for example, if you were to hedge away your US dollar risk into ringgit risk, right, you actually don't have to pay. You actually get paid about 100 basis points to actually sell US dollar forward against ringgit. So you actually get paid to hedge away the FX risk if you are Malaysian-based investors. So the first 2 risks, the interest rate risk and FX risk, can actually be hedged away at a very, very reasonable cost. Now, the third risk is the credit risk. Credit risk, how we define credit risk is the risk that the bonds that you buy runs into some problems. So either the bonds default, or there's some negative news that hits the bonds and the bond price goes down sharply because of some risk relating to the operations of the company. Now, this credit risk, unfortunately in Asia, you can't really hedge it away because there's not an active CDS market for most of the Asian bonds. But what you can do is that if you were to do rigorous and proper credit analysis, you should be able to fairly easily avoid bonds with bad credit fundamentals. So again, the third risk, the credit risk, while you can't really readily hedge away the risk, if you do enough due diligence, you should be able to minimize this risk quite comfortably.
Within Asian debt, is there one idea or country that you feel particularly bullish or bearish about?
Well, within the Asian bond market, I do really like the Chinese single B and double B, single and double B bonds. And while this sector has really gotten a bad name, right, in terms of corporate governance, in terms of bad operations and bad performance and bad cash flow, right? If you look at the yield of these companies, a lot of these companies, the single and double B names, are trading at very good, very decent yield of between 10 to 15%. And I think this kind of yield actually more than compensate the underlying risk of the companies. So in fact, there are a lot of very good single and double B names with very good balance sheet that is trading at double-digit yields. And I think this particular sector as a whole is actually undervalued, and I do see a lot of value buying this kind of bonds. Now, for bonds that I am negative, I generally would not want to buy bonds that are being issued by, for example, by Vietnam, simply because this country faces a steep downgrade risk as the country has been running a very high inflation number, as well as its external balance, like its current account balance, has been deteriorating quite sharply over the last several years. So I won't really be comfortable investing in bonds that's being issued by any Vietnamese companies. Yeah.
What is your advice for Malaysian investors looking to invest or are currently invested in Asian debt?
Well, I think for Malaysian-based investors, right, traditionally they have, when they buy fixed income products, they have been mainly or predominantly buying just Malaysian-denominated local companies. Now, I think the Asia US dollar bond market actually provides a very good alternative to diversify their fixed income holdings. Now, the Asian US dollar credit market or the bond market is different from the domestic local currency market from the fact that this Asian bond market has better liquidity and much better debt, in the sense that they have issuers not just from Malaysia issuing this market, but also from much of the rest of Asia. And at the same time, they have buyers not just from Asia buying this Asian bond market, but also investors from US as well as investors from Europe. So in terms of debt and liquidity, the Asian credit market or the Asian bond market definitely provides much better liquidity and debt compared to the local currency bond market. Now, in terms of what to buy within Asian credit market, I've of course earlier mentioned that I think a lot of the high yield bonds, particularly the Chinese single and double B names, the yield does looks very, very attractive versus what the investors can get buying the local currency bonds. In terms of what to look out for is that I think one of the key risks that investors based in Malaysia have to watch out for will of course be the currency risk. If Malaysian investors were to buy a US dollar Asian bond, and of course if the ringgit were to strengthen against the US dollar, this could cause them to lose money on their Asian bonds. So I think for Malaysian-based investors, if they were to buy Asian bonds, right, the one advice that I'd like to give is that they should consider hedging away their currency risk by selling US dollar and buying ringgit forward. And there's actually no cost to doing this because the interest rate in Malaysia is higher than US, and hence if you hedge from US dollar to ringgit, you actually get paid about 100 basis points on an annualized basis.